Hello, everyone. So, as I said last class, I will be recording this video to go over some of the material that we did not get to cover, or that we may have covered some of it very, very briefly. So, I'm going to go into more detail into the next few slides. And then at the end, I'm going to go over a schedule of cost of goods manufactured question that is posted in the beginning of these slides for review so that you can use it to double check your answers to that question to see if you're on track or if you need more help. If you do need more help in that chapter, you can either attend your tutorial, or you can attend the tutorial office hour, or you can book a spot with me in my office hours on Wednesday. Okay. So target profit or income cost planning. The manager knows the sales volume and the desired profit. So we're imagining that a manager knows the sales volume and the desired profit. So what they're trying to find out is the variable cost per unit, or maybe they might be trying to find out the total fixed cost needed to achieve a desired operating profit at that specific sales volume. So I have here quantity is equal to fixed cost plus targeted profit divided by selling price plus variable cost per unit. And if we remember from last class, the break even in units is equal to the fixed cost divided by the contribution margin per unit. But in this situation, what we want to figure out here is the variable cost per unit. And we notice that there's another aspect of this equation here, targeted profit. So in a situation where we're trying to figure out how much sales must we sell, how much must we sell for us to be able to cover our fixed cost and achieve a targeted profit, then the regular break-even formula changes from just fixed cost divided by contribution margin per unit to fixed cost plus targeted profit divided by a contribution margin per unit. So if you're giving a question where they give you the quantity, the fixed cost, the targeted profit, the selling price, then you can manipulate this formula in order to come up with your variable cost per unit. Okay? So whenever you're doing questions where they're asking you, for example, they can ask you for a selling price, right? They can ask you for fixed costs. They can ask you for any of these variables in these equations. And what you need to be able to do is figure out, first of all, what is the question asking you to find? And second of all, which information did they give to me? And so once you're able to figure out those different variables, you know exactly which formula you're going to be using. So I can demonstrate for you, I'm going to demonstrate for you exactly what I was just talking about. So an example of how we can use this formula of the break even to find a different variable. Okay, so we're going to be looking at a company called ADMS company had a break-even point of $350,000 based on a selling price of $5 per unit and fixed cost of $112,000. In 2022, the selling price and the variable cost per unit did not change, but the break-even point increased to $420,000. Part A is asking us to calculate the variable cost per unit and the contribution margin ratio for 2021. Now we can see that the formula is selling price minus fixed cost divided by a quantity is equal to our variable cost per unit. Now you can see what we did. We started off with this top formula here that helps us to find our break even. Okay, and then we were able to rearrange the formula so that we can solve for variable cost per unit. Just more specifically, this question does not talk about targeted profit at all. So the actual formula that we're using is selling price minus fixed cost over quantity is equal to variable cost per unit. So here's an example of how we can use the break-even formula to find a different variable. And in this case, part A is asking us to calculate the variable cost per unit and the contribution margin ratio for 2021. So selling price minus fixed cost divided by quantity is equal to our variable cost per unit, okay? Selling price minus fixed cost over quantity is equal to variable cost per unit. Now, this question does not include a targeted profit. So once we have rearranged the formula in order to solve for variable cost per unit, we end up with this formula down here. But because this question does not include anything that talks about targeted profit, you're just going to take that out. So that's how we get to selling price minus fixed cost over quantity is equal to variable cost per unit. So what we see here is in this question, it says that we have $350,000 of a break-even point, okay? And based on a selling price of $5 per unit, fixed cost of $112,000. So we know what the fixed cost is. So we have that figure. The fixed cost is $112,000. We know that the $5 here, $5 per unit is a selling price per unit. So the $5 goes there. What we don't know is the quantity. We don't know the quantity of break even, or we don't know the break even point in units. That's what the quantity stands for here. This is the break even point in units. Okay, this is the original formula. So Q stands for break even point in units. So what we're going to do is we see that they gave us a break even point of $350,000. Now, how do we find the break even point in units? Well, if we take $350,000 and we divide that by $5 per unit of the selling price, that will give us the number of units that we need to break even. And that's what you'll see that I did here. So this gave us 70,000 units. So with 70,000 units, we now have the quantity and we can solve for variable cost per unit, which is 3.4. So the variable cost per unit is 3.4 or $3.40. Now the question asks, can you calculate the contribution margin ratio for 2021? So we know the selling price is 5. We now know what the variable cost is of $3.40. And once you divide that by the selling price per unit, you can come up with your contribution margin ratio. Now, you can also find this figure by using the total amounts, okay? So the sales amount of $350,000 minus our variable cost total, which will be the 3.4 times the 70,000, which is 238,000, And you divide that by the sales amount, which will give you the same thing, 0.32. So I'm going to write that down there as well. So if we did 5 take away 3.4, and you divide that by 5, that's also going to give you 0.32. Okay. Now, part B asks, calculate the increase in fixed costs for 2022. Now, I'm thinking to myself, in the question, we have been given a break-even point of $350,000, selling price per unit of $5 per unit, fixed cost of $112,000, 30.32 or 32 cents for contribution margin ratio. And we're asked to find out the increase in fixed costs for 2022. Now, which formula comes to mind that we can use to isolate the fixed costs given the information that we have, right? And so what I realized is that, well, we can use the break even in dollars formula, right? Because we know how much the break even point in dollars is in 2022 of $420,000. And we know what the ratio, the contribution margin ratio is, which is 0.32. So we can find out what the fixed cost is in 2022. And if we know what the fixed cost is in 2022, then we can calculate how much the fixed cost increased by from 2001 to 2022. So in this case, X over 0.32 equals $420,000. In order to find X, we're just going to multiply $420,000 by 0.32. This is math, right? So $420,000 times 0.32 gives us a fixed cost in 2022 of $134,400. And remember, fixed cost was $112,000 in 2021. So when we do 134,400 minus $112,000, we realize that our fixed costs have increased by $22,400. Okay, so it's about thinking of the information that you have and finding out from that which formulas can you use in order to solve for the missing piece. Think of it like a puzzle. Pieces missing. Which pieces do I have? And how can I rearrange these pieces in order to solve for the missing piece? Okay. All right, let's just jump straight into the sales mix. So we realized in companies, a lot of the times companies sell more than one product. And one of the critical decisions that companies have to make is what mix of products to sell. In other words, how much of this product should we sell versus that product, so that we can ensure that we are making the optimal amount of. Okay, so companies are interested in the optimal profit, okay? And the way that companies usually decide that is they basically look at the product that has the highest contribution margin. So we would want to ensure that we are selling more of the product, or producing and selling more of the product with the highest contribution margin, because that's what's going to contribute most to our operating profit, right? That's going to contribute most to paying off our fixed costs and leaving us with a profit. So when you have a mix of two or more products, these are the steps that you take. You will calculate the weighted average unit contribution margin of all the products. So how do we do that? So the weighted average unit contribution margin. So we know how to calculate our contribution margin per unit. And now we're thinking of an average. All right. So imagine that we have two products, DVD players and TVs. And the contribution margin per unit for DVD players is 200. The contribution margin per unit for TVs is 500. Now, to calculate a weighted average unit contribution, what we're going to do is we're going to multiply each of these unit contribution margins by the sales mix percentage. Add those up together and we get a weighted average unit contribution margin. So once we find our weighted average unit contribution margin, we can now calculate the break-even point in units. So it's the same formula. The only thing that's changing here is the weighted average part of it. But we found it in the previous slide of 275. And we're just going to divide that weighted average unit contribution margin by our fixed costs. And that will give us our break-even point in units. So a company here called Vargo Video Basic Data sells both Blu-ray DVD players and TVs. Fixed costs of, and they have fixed costs of $275,000. Now, before you saw that we needed to calculate a sales mix percentage. And this is how you do it. It's very, very simple. So we notice here that Blu-ray has $500 in selling price, variable cost of $300, contribution margin of $200. $1,000 selling price for TVs, variable cost of $500, contribution margin is $500. Now with the sales mix in units, sorry, I thought that there were the units on this slide, but let's imagine that, for example, we had 1,000 units of DVD players and we had 200 units of TVs. So in total, there's 1,200 units of all the products combined. So 1,000 for DVDs, a sales mix with percentage will be 1,000 divided by the total 1,200. And for TVs, it will be 200 divided by the total 1,200. That's where you're going to get the sales mix percentage. Okay? Because we're calculating the break-even sales in units, we're going to be calculating the sales mix percentage from the units that you sold. Okay? So here are the units, and this is exactly what I was saying before. Remember before we have a 75% sales mix percentage for the Blu-ray DVDs and a 25% sales mix percentage for the TVs. All we have to do is we have our total units of all the products combined. 750 divided by 1,000 is 75%. 250 divided by 1,000 is 25%. That's how we get our sales mix percentages. Once we have our sales mix percentages, we can find our weighted average contribution margin per unit. Once we find our weighted average contribution margin per unit, we can find our break-even point in units. So as I said before, at any level of units sold, operating income will be greater if more of the product with the higher contribution margin in units are sold than the ones that have a low contribution margin per unit. Okay, so in this situation, we should be selling more of TVs in order for us to really maximize our operating income. Now, this is the example for the break even in sales dollars. And we recall that the break even in sales dollars formula is the fixed costs divided by the contribution margin ratio. That's how we find the break even in sales dollars. Now, when we're trying to find out a weighted average contribution margin, if we want to find it in sales dollars, what we're going to do is we're going to find the first, just like we did before for the break even in sales units, is we're going to find a sales mix percentage. But we're using, in this case, a sales mix percentage for dollars. So $200,000 and $800,000 were the amounts sold in dollars for both of these types of plants. The two products sold at Kale Garden Supply. So the sales mix percentage will be $200,000 divided by 1 million and $800,000 divided by 1 million, giving us a sales mix percentage of indoor plants 20%, and a sales mix percentage for outdoor plant division of 80%. So now that we have this, we can calculate our contribution margin ratio. Okay. So our contribution margin divided by our sales gives us a contribution margin ratio. 80,000 divided by $200,000 gives you a 40 cents or 40% contribution margin ratio for indoor plants. $240,000 of contribution margin divided by $800,000 gives us a contribution margin ratio of 30 cents. This gives us a total contribution margin ratio of 32 cents. What is the weighted average unit contribution margin ratio? So we know the sales mix percentages. How can we find the weighted average unit contribution margin ratio? So we know the contribution margin ratio for both of our products, 40 cents and 30 cents. We just have to multiply it by the sales mix percentage, each one by the sales mix percentage, and that's going to give us our weighted average contribution margin ratio. So once we have our weighted average contribution margin ratio, boom, we can calculate our break-even point in dollars. $300,000 of fixed costs divided by our weighted average contribution margin ratio gives us a break-even point in dollars. So a quick review. In a multi-product CVP analysis, the weighted average unit contribution margin is simply the contribution margin per unit, A, the contribution margin per average unit, B, the contribution margin per segment, or D, the contribution margin per business unit. The answer is B, the contribution margin per average unit. Now on this slide, I just have a summary of the two formulas to find our break even of multiple products. And there's also a quick video here that you can look at if you want more, you want to see this in a different perspective, maybe from someone else, that can increase your chances of you really grasping the concepts. On this page, I also put a couple of steps that you can use to come up with exactly what we just did in the previous slides. The next slide deals with uncertainty. How do we deal with uncertainty? So when you think of a business, a company, there are a lot of uncertainties in business. Sensitivity analysis talks about how sensitive are profits to changes in selling price, variable costs, fixed cost, and volume. We can also measure our operating risk using two approaches, margin of safety and operating leverage. Margin of safety shows us margin of safety in sales dollars. We can calculate a margin of safety in units. We can also calculate a margin of safety ratio. Let's go into the margin of safety ratio first. A margin of safety ratio is calculated by dividing our margin of safety in dollars by the actual or expected sales. But how do we calculate a margin of safety? Your margin of safety is the difference between your budgeted sales and your actual or expected sales. So it's like a safety net. Think of a safety net. Your break-even sales tells you how much sales you need to make in order to make a profit of $0. A margin of safety tells us how far can your sales fall before you get to your break-even and then start making a loss. The higher your margin of safety or the margin of safety percentage, then the greater the margin of safety. Okay? The greater the margin of safety. So the margin of safety refers to A, the amount by which profits exceeds break-even sales, the amount by which sales exceeds break-even sales, the amount by which sales exceeds expenses, or the break-even point. And the correct answer is B, the amount by which your sales, actual or expected sales, exceeds your break-even sales. How much can you fall? How much room do you have to fall before you hit your break-even sales? An example of the margin of safety. Imagine a safety net, as I said before. How far can our sales fall before we start making a loss? the equation for margin of safety is planned or actual sales minus your break-even sales. And as we said before, the margin of safety ratio is your margin of safety divided by your sales. So if we have to choose between two products, the product with the lower margin of safety is riskier. Remember, this is talking about sensitivity analysis. How sensitive are we to a change in sales? How sensitive is our profits to a change in sales? Okay, so the higher the margin of safety, the better. So using the data provided, compute the margin of safety and the margin of safety ratio. So we know here that the units sold is 1,000. Okay, so looking at our formula, we already have 1,000. Okay, margin of safety, we'll call that X is equal to 1,000 minus break-even sales. Our break-even sales we don't know, so we have to find it. So break-even sales is equal to, let's call it break-even, is equal to our fixed costs divided by our contribution margin per unit. That'll give us our break even in units, right? So what information do we have now? We have our fixed costs, a total of 2,000 plus 1,000. So you can see where that comes from. So that gives us 3,000. And we're going to divide that by our contribution margin per unit. And our contribution margin per unit is our selling price minus our variable cost. So we have a price of $10 minus our variable cost. So we see that we have $10 minus, we need a variable cost per unit. What do we have here? We see variable manufacturing costs and variable selling costs. They're 5,000. $5,000. So what is the variable cost per unit? It'll be $5,000 divided by 1,000 units. So that'll be 5. So $3,000 is equal to $3,000 divided by 5, which is our contribution margin per unit, $5 per unit. Gives us 600 units. So we need 600 units to break even. And we already know that we have sold 1,000 units. So 1,000 minus 600 gives us a margin of safety of 400 units. That means that our safety net is 400 units. We can fall by 400 units before we get to our break-even point. We can fall by 400 units of sales before we get to our break-even point. That is what the margin of safety is going to tell us. Now, what is our margin of safety ratio? We literally just take the 400 units and we divide it by our sales of 1,000. And this is 40%. That is our margin of safety ratio. Okay, remember, the higher the margin of safety ratio, then the less risky the company. Another form of sensitivity analysis is the operating leverage. Comparing the relative fixed costs to variable costs. Comparing the relative fixed costs to variable costs in a business. So the higher the relative fixed cost, the variable cost, that means the higher the operating leverage. If a business's operating leverage is high, then that business is more sensitive to changes in sales. That business's operating income is more sensitive to changes in sales. The formula is contribution margin divided by operating profit.
Usually bras fit small-chested women like this.
Yapping. You guys.
Okay, let's look at this quick video on operating leverage.
Operating leverage is the relationship between a company's fixed and variable costs. The airline industry tends to have high operating leverage. The fixed costs for high-fly airlines include hangar rental, leases for its aircraft, salaries of its crew paid annually, and aviation insurance. Its variable costs are refreshments for passengers and jet fuel. Highfly's fixed costs are higher than its variable costs. Therefore, the company has a high operating leverage. A company with a high operating leverage like Highfly will see its profits go up when its ticket sales increase, because fixed costs remain the same. Likewise, a company with low operating leverage in a declining sales period must still pay its fixed costs, and it will thus suffer bigger losses. The degree of operating leverage, DOL, of a firm measures how well a company generates profit using its fixed costs. It is calculated as sales minus variable costs divided by profit. If Highfly earns ticket sales of $3,000 and has variable costs of $300 and fixed costs of $1,000, then its profit is $3,000 minus $300 minus $1,000 equals $1,700. Its DOL is $3,000 minus $300 divided by $1,700 equals 1.6. Highfly's competitor LowDrive also earns bus seat sales of $3,000. Its variable and fixed costs are $900 and $400 respectively, for a profit of $3,000 minus $900 minus $400 equals $1,700. LowDrive's DOL is $3,000 minus $900 divided by $1,700 equals 1.2. Highfly's operating leverage is higher than LowDrive's given their DOL. If both companies experience a 10% sales increase, Highfly's profits will rise by 16%, while LowDrive's profits increase by 12%. A 10% sales decrease for air and bus tickets will bring about a profit loss of 16% and 12% for Highfly and LowDrive respectively. This example shows how operating leverage magnifies both profits and losses.
So a company with or a business with a high operating leverage, if their sales increases above break even, an increase in sales will cause profits to increase by by that same rate of that operating leverage rate. But if the sales fall below break even, then that same company with a high operating leverage is going to experience a drastic fall in falling operating income, or it's going to experience a high amount of losses. Okay. So this is exactly what the video talked about. If both companies recorded a 10% decrease in sales, then Vargo has a lower degree of operating leverage. So their losses would not be as much as the New Wave's losses. So Vargo Video's operating income will decrease by 26.7%. And then the New Wave's operating income will decrease by 53.3%. Okay. So very quickly, I'm going to run you through the exercise E636. Mega Electronics sells television sets and Blu-ray DVD players. The business is divided into two divisions along product lines. A variable cost income statement for a recent quarter's activity is presented below. They gave us the contribution margin for both of the products in both product lines, total fixed costs, operating income. Determine the percentage of sales and the contribution margin for each division. So the percentage of sales is like our sales mix percentage that we talked about. So 800,000 divided by 1 million will tell us the sales mix percentage for TVs. That's 80%. And 200,000 divided by 1 million will tell us a sales mix percentage for the DVD players. That's 20%. What about the contribution margin? Same thing. 240,000 divided by 800,000 is going to give us our contribution margin ratio. And 40,000 divided by 200,000 is going to give us our contribution margin ratio for the DVD players. So that's 30% for TVs and 20% for DVDs. So we have here a percentage of sales or a sales mix percentage, and we have our contribution margin ratios. So now that we have that, can we calculate the company's weighted average contribution margin ratio? It's very simple. You just take the sales mix percentage or the percentage of sales and multiply it by your contribution margin ratio. So 80% times 30% plus 20% times your contribution margin ratio for DVDs of 20%. When you add those up together, you get 28%. Part C says, calculate the company's break-even point in dollars. I like this question because it's showing you each part of this question is like the steps. So A is step 1, B is step 2. And we already knew they were going to ask us for break-even point in dollars because they asked us to calculate the contribution margin ratio. If they had asked us to calculate the contribution margin in per unit, then we would have had an idea, oh, okay, we're probably going to calculate the break-even point in units. And at the same time, we would have also calculated our percentage of sales in units as well. So our break-even point in dollars is our fixed cost divided by our weighted average contribution margin ratio, $140,000 divided by a weighted average contribution margin ratio of 28% is equal to $500,000. And part D says, determine the sales level in dollars for each division at the break-even point. So therefore, at the break-even point, we should be selling more of the product line with the highest contribution margin ratio. And that is our TV division. So we'll be selling 80% of the break even in dollars of TVs, and then we'll be selling 20% of the DVDs, $100,000 worth. Okay. On this slide, it just gives you some of the different knowledge targets, reasoning targets, skill targets. These are just guides to help you when you're studying. And the last slide asks a bunch of questions. You should ask yourself, do I know how to answer these questions? Look for examples in your textbook that may ask you to find the answers for these types of questions. Okay. So the last thing I'm going to do is I'm going to post the example of the schedule of cost of goods manufactured, and that will be in a different video. So thank you very much for your time, for listening to part 2 of our week 5's lecture. Have a good day or night, everyone.